Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Henry Stimler, Executive Managing Director at Newmark, a global commercial real estate firm. He joins me to discuss housing needs for millennials, multifamily properties, and fixed versus floating interest rates. It's great to have you with us, Alex. Welcome to Trade Talks.
Hi, how are you? Thank you for having me.
Doing well, Henry. Thank you. And what did the great COVID migration mean for the housing market?
Well, you saw a tremendous shift out of predominantly two places, New York City and California. There was a great in-migration to Texas and a great migration to South Florida. You've seen a boom in South Florida in the housing market, in the multifamily sector. You've seen a tremendous boom in markets such as Austin, Dallas, to a part Houston, and then you've seen the emergence of the Carolinas. So in effect, the winners of COVID was the Sunbelt states, and the losers was California and New York less so, but definitely California and Chicago really were the ones that got pummeled. Great move of offices as well. Big commercial firms leaving them in droves and going to red states where it's better weather, better taxes, better politics, and that's been what we've seen.
And we know that there's a slowdown occurring in housing now, whether it's due to interest rates or supply and demand issues. But what does the slowdown in housing mean for multi-rentals? And what are the trends that you're seeing in blue versus red states?
So I think there's always a silver lining here. So because it's so expensive to now buy a single family home, more and more people will stay as lenders. And also people that wanted to sell a home, they can't go and buy something easier. They bought their home, they locked in 3% interest rate, they're going to sell their home, buy a new home at 6-7%. It's not so attractive to sell your home. So typically the renters migrate and become single family owners. Those renters will now stay for longer. And so you're going to have a little bit of a stuck pipe. Instead of those people moving into their first homes, kids coming out of college, becoming renters, now you've got a bottleneck. More people will stay as renters. More kids will leave college and look to become renters. So we are becoming a nation of renters rather than a nation of part renters and part buyers. So we saw explosive rental growth during COVID in certain markets. I'm not sure we'll see explosive rental growth, but I don't see we'll see a decline in rent because of the slowdown in single family homes. So the multifamily sector, the fundamentals are very good, very strong.
Right. Well, it's not only due to interest rates. The fact of the matter is housing is unaffordable. And, you do have a lot of private equity shops that are buying up first-time home buyer affordable homes. So my question to you is, how is a housing slowdown impacting millennials and what is specific to their housing needs?
Well, I think millennials don't really care for housing. I think it was a dream of our parents to be first-time homeowners. We've already seen a trend going away from that. The desire to be a homeowner is not so strong with millennials. They want to be able to up and leave. They want to go and work in code and snowboard in Utah. They want to be able to be very much more transient. So we've seen that already. So that desire that our parents had of getting on the property ladder, that is not such a huge factor with millennials. And more people are renting for longer and longer. And especially now with interest rates, it's more sustainable to be a renter than to be an owner.
Let's talk about interest rates. They are at the forefront for all different kinds of markets and for investors. What are your thoughts around fixed or floating as it relates to housing?
So right now, all the loans that we tend to do are going to be fixed rate loans. People are very scared to take floating rate loans. The cost of floating rate loans is very high. And then you've also got to buy an interest rate cap. And those interest rate caps are becoming so incredibly expensive. Also, with fixed rate loans, you've got longer runways. So your typical floating rate loan is going to be 3 + 1 + 1 5-year loans or a 7-year floater. With fixed rate loans, you can take 7-year, 10-year, you've got a longer runway. A lot of the more conservative institutional buyers are now going to lock in 5, 7, 10-year fixed rate finance rather than floating rate options, and also be exposed to the interest rate caps, which come due every few years. And right now, with the movement of the SOFR curve, those are becoming unbelievably expensive. That's a sunk cost that you never get back. You're buying the cap for insurance and it's gone.
Right. So, Henry, if you were to lock in a loan at 7%, when does it start to make economic sense to refinance? Let's say rates get back to 4 or 5%. Of course, there's a cost to refinancing. When does it start to make sense?
Well, you've got to look at your yield maintenance. You've got to look at your defeasance. You've got to understand your load. And then you've got to look at the market. To be honest, we've had very low, historically low interest rates. Then we saw the Fed react very aggressively. Some say too slowly. They should have reacted much faster. and started raising interest rates much quicker, but they've gone and done 7 rate hikes, one after the other. So you've got incredibly high interest rates right now. I can't see them. I can see them slowing down, which you already see today. They're slowing down on the hikes, but I can't see it coming down anytime soon. So I think we're going to have quite a 2 to 3 years of this kind of interest rate. So there's no huge fall off a cliff coming back to the interest rates we had over the last few years.
All right, Henry, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you. Have a good day.